Welcome to TradeTheMBI.com. This is John. This report is for the 8th of April. And, well, once we got back above the ABM green and it was enough support right here on the 61%, we pushed right back above the 76%. Still relatively degraded from the reading standpoint, but the short-term buyers were enough to hold that support. And now you're above the 76. It becomes pretty straightforward. Still below ABM yellow. I would expect softness and continued weakness, and certainly likelihood if we break below the 76% right here, you would see continuation because you still don't have any indications that midterm, long-term buyers. It's just we don't have that many shorts pushing things, so it's just a relative lack of buyer situation construct at this particular stage. And you're getting these readings back and forth of jobs that are popping in, but when you look at the realities, they're just short-term part-time jobs. So it's skewing the numbers. You can only keep doing that for a certain length of time before the reality hits. And what we've been seeing is that they post an artificial number, and then the next month they revise the previous month down and make the adjustments. So you've got a situation where the economy continues to plug away, and we've talked about this with the labor disruption. It's like you have a situation where there was a shortage of labor, and because of that, you're still having advancing GDP, but also that's a little misleading because at the end of the day, the government is spending $1 trillion extra every 3 months, and it's skewing the results. And the problem is, anytime that you're going to get the government sector actually outperforming the private sector, you're completely unsustainable trajectory. And that's really the case of where things are at this particular stage. The question is, how long can it go? And like we've said before, it can go quite some time because they just have the complete ability to just print money from nothing, and they're going to continue to do it. The Nasdaq has not had a dip below the red line, so it has been in a much more stable environment, I want to say, as far as the selling goes. It reached its 50% from a Marcanacci line there was enough for the sustained support. It's still below 76% in that. So we've got softness, and it's literally just going to be an allocation of anticipating that there's going to be continued inflation. And will the Fed cut into a rising inflationary environment? And that really becomes the question, because to do so seems like folly and foolishness, but you're also got a situation where there's so much debt, and that keeping rates at this artificial, well, not artificial, but it's actually artificially low relative to what it should be, is still problematic because you take the chance of running inflation out of control, all for the what? The sake of market value, and that doesn't seem like it makes a whole lot of sense from that standpoint. When we look at treasuries, we're still at the bottom end, which means the bond market has come to the realization that yes, it's likely that rates are not going to move, or at least in the near term, particularly as long as oil remains at these levels. This is going to spike inflation at a significant level throughout the economy. There's just no way around it. And the potential for it to get worse still exists. You have the Israeli conflict, you have the sanctions with Russia, and there's a lot of supply disruptions, and any additional issues can heighten that. We've seen the Ukrainians try to attack some of Russia's oil infrastructure. Even that supply disruption would cause a significant increase in pricing. So there's a lot of potential headwinds. Now, that said, there's also a lot of money that continues to flow in, and where are you going to put it? Rates aren't high enough, so you've got your choice to keep it in the market or to move it to alternative inflationary hedges, which would be your crypto and or gold, which we have seen making significant moves. The euro, from its standpoint, interestingly enough, the reports that came out, the Eurozone barely holding on to positivity. And it was interesting because actually the south of Europe, Italy and Greece and that, have actually shown better performance than the northern part of Europe, which bizarre, but you have the added elements of tourism and some of the pushback against some of the policies that are counterproductive to growth. But look at that, you see gold, and it's going to continue to explode, and we've talked about this. Of course, there are people who give these fantastic expectations, and eventually they'll get there, the $4,000 or $5,000 per ounce range, because there's no reason why it wouldn't, given the fact that there's not going to be any change, at least this year, and potentially going into the next and following, of outrageous spending that is not sustainable as far as a growth standpoint. So you're just going to keep piling on trillions and trillions in debt. It's already reached the largest budget consideration from an interest standpoint. So the only other way is to go to zero interest rates, which would help a lot. But at the end of the day, what do they care? They just keep printing more money to pay the interest on it. So there you have it. And this is going to result in crypto and the other assets skyrocketing. Now, of course, Bitcoin will be an interesting one. You have the halving coming up anytime. And when that takes place, all the miners will be getting half what they were getting before, which, given what electricity rates are with rising inflation, could be problematic as far as how they maintain that. And it'll be interesting to see what comes of that situation from an ETH standpoint. Slightly lagging relative to what Bitcoin's doing, but there's still a lot of unresolved situation as far as regulation and how cryptos are going to be treated, despite all the encouragement from ETF standpoint and everything else. But at the end of the day, it's still an alternative, and it's easier to sometimes play than the idea of having physical gold, which is why the futures and gold contracts and paper gold trade has always been interesting. But as we know, it gets bifurcated from the real world, because to buy the physical thing versus the paper, not always the same. But again, that's the whole point of having futures for cryptos in that as well, because you get the arbitrage, and that creates movement. And movement means you have activity. So here we are from a 50K standpoint, and we had this NBI white spike. And as I was mentioning, that potentially could lead to a move back towards the zero mark. We had the same situation here, and then we had the divergence. So we did the same thing where it popped up, and literally it was a question of, when is magenta going to dip below yellow? And I said, that's just the question. When the magenta dips below yellow, then you've got your signal. But until then, you have to wait. And it never did it. So we got back above the 23%. It supported for a while, came back and forth, but that magenta stayed above. And then shorts literally just exited that. And that was enough to drive price up over the 50%, right at it right there. But again, we're probably looking at a secondary situation where, like, here we had the spike, and then a secondary one comes, and that's the one that's going to move things lower. So interesting. But it's almost like a repeat of this setup right here. It eventually will do it. It's just a question of how much of deviation to the upside we were going to get. And once you had that crossover there, we came back to the 38, but there was no short activity to sustain the move. So unlike here, where you have that crossover, then you get that continued blowout. So we have to look for the next NBI white spike to expect that. And you can see we then started at the beginning of the green move with shakeout gold rising. And so as long as that's rising, positive shakeout, things are holding on. Intraday, from its standpoint, it was green, and then it was more green. And then they filled back in some of the positive extremes that came back all the way through here. Still a little bit further to go to beat those dips, but then you filled in the other move that came up across. And here we are in the post market, making the attempt to fill that back in. Not bad. I mean, we're pretty much at parity right now. So it's going to be another start. And again, I would expect the volatility to be significant, simply because, again, you're going to have a whole other set of option plays that will take place. They're going to have to push that gamma back and forth until they can just neutralize its effect. And that's been sort of what's been taking place for the last many months here, as far as how the market's been treating behavior. But the uncertainty of a lot of things, I think, is going to start to create more of that back and forth action, which I think probably should lead to an eventual softening overall from a value standpoint. But again, there's just a lot of influx at this particular stage of the game, and with that, shorts that add in become fodder for pushing things higher. So we'll continue to follow the charts and the readings as they go. As always, though, anything relevant, I'll put on the Skype chat. Have a good one. Trade well.